Good afternoon, ladies and gentlemen. This is the welcome to a webinar of our Research and Policy Network European Financial Architecture. We will speak, or we will discuss today the topic financial resilience after Silicon Valley Bank experience of March of this year. And we want to investigate whether there is a need and what are potential options for reforming deposit insurance. And in this context, the role of the lender of last resort. So that will be our topic. And if I can remind you, the crisis has almost been forgotten by now because we have had so many other crises since then. But it was quite a surprise, at least to me, and I think to many observers, that we would see such a, I would say, almost a textbook-like run in the banking industry nowadays, with all these protective and other measures that we have invented over the years. So that was what we could see at Silicon Valley Bank, and it was not just this bank. There were a few others that were affected quickly, and then it was also coming across the Atlantic, and we had another type of run, maybe with another reason, but the same type of development at Credit Suisse in Switzerland, where, of course, the amounts at stake were far larger than at SVB. But even SVB, the amounts were quite large. And the latest number that I could find is that there's now a loss of 16 billion that has to be somehow allocated to the different members of the FDIC, so that it can be fully basically booked and being covered. So that's the situation now. And of course, the interesting issue is there anything that we can learn from this experience? As always, that's our task as economists. In a way, my basic question is, do we need a bank run? And if we need bank runs, so how can we somehow have them in a somewhat efficient way? And is the way we have organized our deposit insurance already efficient, or can we do any better? So is there a need to reform what we have? And then how could it be done? And I think Steve Cecchetti, who is the main speaker today, has a good mix of policy alternatives that he will present to us, and that's a good basis for discussion. And Vasso Ioannidou from Bayes School, City University of London, and Hugo Bänziger, who has been living through such risk management experience in his banking life, will be discussants in this endeavor. And then we have a debate, and I want to encourage everybody who has questions to put them in the Q&A section of our page, and we will then try to answer them in the panel. So thank you for coming, and also a lot of thanks to Steve, Vasso, and Hugo. And I want to hand over to Steve, and let me just start with a few words on his background. He's from Brandeis University, has a PhD from Berkeley, and was for many years the head of economic and monetary department at BIS, and later had various other positions, and one being now presently to be on the advisory scientific committee of the ESRB. And in that position, of course, he quickly had to judge and make some assessments about what had been going on in the US. What does this mean for Europe, where this scientific committee is active? Stephen has published in all major economics and finance journals, so he has a very solid academic background, but also a vast, I would say, experience as a policy advisor. So I'm very happy to have you here, Stephen, and I want to hand over the screen, I would say now, to you, and ask CEPR to start the presentation, please.
Thank you very much, Jan, and let me thank you and Elena and CEPR for putting this very nice webinar together. And I have a few introductory comments But let me start by saying that my remarks are based on several chapters of an ebook that was put together by my friends at the New York Stern School of Business and was published or made available several months ago. Specifically, I'm going to discuss the parts on deposit insurance and the federal home loan bank system. These were chapters of this book that I wrote with my longtime collaborator, Kim Schoenholtz, as well as Larry White, who at one point was on the Federal Home Loan Bank board, and as well as Thomas Philippon. They bear no responsibility for my comments. Let me start by outlining what I see as the 4 failures of SVB. We can debate these, it doesn't really matter. I think there are different perspectives on this, but there's some version of all of these. I think people would agree. The first one is that there was a risk management failure by the banks. SVB was engaged in extensive maturity transformation, issuing large quantities of uninsured deposits to a concentrated set of customers who were in fact connected. So there was a concentration on the liability side, and they invested the proceeds in long-term bonds, mostly treasuries, but that's not really the issue. But that was a concentrated exposure on the asset side. And during 2022, during the period when interest rates were really rising quite sharply in the US, they actually extended the duration of their assets by nearly 2 years. So this seems to me to be a rather risky thing to do, but that's what they did. The second failure is that markets failed to discipline SVB. If you look at the quarterly disclosures made by SVB, they were close to insolvency on a mark-to-market basis by mid-2002, but they were still able to fund themselves at relatively low cost. Now, I'm no expert in reading these public disclosures, but I can find this stuff. And so I think that it was obviously out there. Now, supervisors are the third group of, that's the third failure, and that is that they either failed to detect the risks, or when they did, they failed to apply any timely remedies. This is a rather complex thing that has to do with the governance of the supervisors in the United States and the way in which the fragmented system works, and the difficulty associated with getting agreement first from the people who run the agencies and then among those agencies in order to impose any remedies. Now, finally, authorities delayed resolution, I believe, encouraging SVB management to gamble for redemption. Again, as I said, on a mark-to-market basis, SVB fell below the prompt corrective action threshold of a leverage ratio of 2%, surely by mid-2022, yet it was allowed to operate until the run triggered the widespread panic in early March of 2023. This case is pretty spectacular in how everyone failed at the same time. And I think Jan pretty much said this already, and that is that if you had asked whether I thought that this was possible several years ago, I would have surely said no. The fact that it did happen, I think, requires us to rethink what is needed to ensure financial stability. Now, my collaborators and I draw 2 big lessons from this episode. The first one is that it's impossible for authorities to credibly commit to not bail out even medium-sized intermediaries. Granted, there are losses and equity holders were zeroed out, but no other liability holders are facing losses. The promise is simply not time consistent to not bail them out. And that is, you can't make the promise. You can make the promise, but when the time comes to follow through, the likelihood of a financial crisis being triggered by your actions is going to cause you to renege. I know that I would renege. Now, the second big lesson is that while supervision is essential, we need enforcement of regulatory rules in the same way that we need enforcement of speed limits on roads, although maybe technology is going to take care of that, but so far it hasn't completely. The enforcement of supervisors is never going to be sufficient. And I mean never. Private incentives favor evasion of rules and concealment of risk, So detecting risky behavior and applying remedies is always going to be difficult. Put slightly differently, the authorities are in an arms race with the industry that they routinely lose. I would actually say they always lose. Now, there's yet another issue with supervision, and that is that officials come and go, and the changing preferences of the officials who come and go. This is not about being bad people. It's just about having different attitudes towards risk. And the problem is that if someone's tough, they can't credibly commit their successors to being tough. And everybody knows that the rigor that might be in place now could easily be removed or walked back once the incumbent policymaker changes. And so even those supervisors who are opting to use their discretion rigorously are not going to be able to do any kind of binding or commitment of successors, and that encourages risk-taking. So as we consider reforms, I think we need to keep these two big lessons in mind. So what is it that we should do? First, always remember that banks cannot have both volatile assets and runnable liabilities. The banks that failed earlier this year, all of them, and I guess I would focus on three, which is SVB, Signature, and First Republic. There's a Silvergate was a small bank that serviced various kinds of crypto businesses that also failed, but it was sort of somewhat different in its business model, and it failed without really causing. It failed before these. It failed without causing any serious spillovers. But the point here is that the banks that did fail had both volatile assets and runnable liabilities, and there may be some other banks out there that still have that combination on their balance sheet. Second, the post-crisis reforms look, to me at least, and this is something again that was foreshadowed by Jan's comments, insufficient to ensure resilience in the system. Now, I'm going to discuss three areas for possible reform: deposit insurance, the lender of last resort, and resolution. So before I do get into details, I want to point out that banks, these are two facts about these banks. The first one is that banks have very large depositors. I think that's probably true regardless. But I expect that nearly everyone listening right now knows that SVB's largest depositor was Circle. Circle is a Boston company, actually, that issues USD coin, which is a stable coin that's backed by a combination of bank deposits and a money market fund that holds exclusively US Treasury securities. It's mind-boggling to me that Circle deposited $3.3 billion in SVB and then did not monitor the bank. That's pretty striking, but that's what they did. Now, I shed no tears for Circle. If that's how they were going to run their crypto business, it's hard to complain when things go wrong. But the second case, I think, is quite different. And this is a large SVB depositor that leads me to think, and I think should lead us all to think hard about spillovers from bank fragility. And this is a company called Rippling, not to be confused with Ripple. Ripple is a crypto company that issues something, token called XRP, which is probably its only source of real revenue, but that's another story. Rippling, on the other hand, is a payroll service provider with several thousand small business customers. And the way in which Rippling works is that they receive funds from their customers and then make the payroll disbursements within a few days. Rippling had $545 million on deposit at SVB when SVB failed. And that was the morning of the day that the payroll payments were going to go out. That was Friday morning. And I think that we should think about that because these are essential services, and the question is whether or not we want to force somebody like Rippling to actually take the risk associated with having the deposits that they need in order to meet payroll commitments or other essential expenses, even if a bank fails. Now, this brings us to deposit insurance. I don't have a lot of time. I'm going to go on a little bit long probably anyway, but I'm trying not to. So the first thing is that concerns about spillovers then lead us to think about this deposit insurance, which was created originally to prevent runs. Now, there are four main proposals that I see on how to reform deposit insurance. The first one is essentially do nothing, except for possibly take care of an idiosyncrasy in the US system where insurance is insurance of bank accounts, not individuals. So there are 4,000 plus banks in the United States. You can have a $250,000 insured deposit at every bank. So if you really wanted to, you could have $10 billion worth of insured deposits. That'd be a real pain, right? It's kind of like a logistical nightmare to do that, but it would be feasible, at least in principle. That's probably something that shouldn't be allowed. Oh, I should mention at this point that the deposit insurance premium as it's currently structured in the United States is a premium on all bank liabilities, not just insured deposits or even just deposits. It's on everything. The second possible reform is, which is addresses the rippling problem, is to set higher insurable targets for small and medium-sized enterprises that would allow them to meet payrolls and other expenses. Now, this would invite arbitrage that the insurer would bear only by limiting entry to this high target class, but it might help. Third, we could simply insure everybody all the time and insure everything. You might argue that the FDIC in the US has actually done this since 2008 because it hasn't allowed any depositor to lose anything in the last 15 years. There have been no deposit losses since 2008. And there are going to be no deposit losses right now either. The losses that Jan was mentioning for SVB are in fact to make uninsured depositors whole, or previously uninsured. Now this, of course, commitment ex ante would likely further increase the burden on regulators and supervisors as well as public costs. Now, finally, there is this proposal that Mervyn King has that he refers to as the pawnbroker for all seasons, which I'll mention in a tiny bit more detail. And this allows, what this involves is requiring that all financial intermediaries, banks and non-banks that issue short-term liabilities, post sufficient collateral with a central bank, pre-positioned collateral, to back all of their deposits after the haircuts. So, for example, if a bank has a 100 euro asset posted at the central bank with a 10% haircut, this bank can be funded then with 90 euros worth of deposits and 10 euros worth of equity. With this system, there's no need for deposit insurance since the bank will never become insolvent and the central bank lending facility will finance any sudden withdrawals regardless of their size. And also, this has the you can decide if it's an advantage or not, but it has the characteristic that the capital requirement is then determined by the haircuts. Now, while it does have one downside, I think, or possibly a pretty big one, and that is that these haircuts become a credit allocation mechanism in the economy, because the pawnbroker for all seasons does have a good chance of ending bank runs, but the haircuts are going to determine what the best collateral is for the banks to post and therefore determine what it is they're willing to hold as assets. Now, this system is untested. No one's tried it, and it seems doubtful that any of the large jurisdictions are going to try it. So I'm not sure it's very realistic, but it's interesting at least to think about. Now, we haven't quite finished analyzing runs because understanding them is key to reforming other policy tools, as Jan mentioned, and that's both the lender of last resort and resolution. Now, it's important to keep in mind that when a depositor withdraws funds from a bank, the funds have to go somewhere. The liabilities can go either to another bank or they can go outside the banking system. The assets can then either go with the deposits. That's the standard case when a deposit goes to another bank and the reserves of the bank that lost the deposits then sends their reserves over to the bank that received them, or the assets can stay where they are. Now, since they cannot hold reserves, the second case where the deposits stay is likely what happens if the depositor shifts to a money market fund. Now, if the assets stay at a government entity, then a government entity has to somehow recycle the funds. Somehow the funds have to get back to the bank to finance the assets that didn't move. And this recycling involves the replacement then of those deposits by some kind of lending activity that's typically not interbank lending, because that's so disadvantaged by regulation that in the US case, at least, it's done either by the Federal Reserve or by this bizarre home loan banking system, which I will talk about briefly.
Steve, one more minute, please. Otherwise.
Oh, okay. All right. Well, I'll go over by 2 minutes, I think. The federal home loan banks, the federal home loan bank system has this lends to banks, and it actually lends against collateral to illiquid intermediaries. And that's like a lender of last resort, but it does this in a much more damaging way. So the first thing is that it's a super senior claim that precedes all other claims, including government entities like the Fed. And it reduces, because of the way it behaves, it reduces incentives for banks to manage risk. This has become a very large system over the years. Some people think it's okay because it lends to non-banks, but I think it's probably not. Now, when we think about the lender of last resort, I think we probably need only one, but there's some principles. The first one is never lend to an insolvent intermediary. If you do, you subordinate other people, require good collateral with a haircut, and charge a penalty rate to induce timely repayment. The problem with the federal home loan banks, for sure, is they don't do these things. Let me just say that we need reform of that system, and the reforms, I think, should. I want to blow it up entirely, but that's unrealistic. The reforms, I think, should be of several kinds. Eliminate this super seniority, put them in line with everybody else. Force them to ensure solvency by requiring that supervisors approve the borrowing, and also require disclosure. It's an incredibly opaque system where they only report quarterly, as any other firm does. Now, the final thing I'll mention very quickly is reforming resolution. And here the most important thing is to measure capital accurately. And to do that, at least for the purposes of resolution, we really need to move to some sort of mark-to-market accounting system. We cannot allow people to be insolvent at market or fair value prices, and continue to operate. So to close, let me give my priorities for reform. First one, increase capital funding. I always say this: capital, I think, is socially almost costless. It may be privately costly, but that's not the issue. We need to strengthen liquidity requirements. We need to eliminate the lender of second to last resort, and we need to impose timely resolution based on an accurate measure of capital. And maybe something that's not quite what I should be saying in this seminar, reforming deposit insurance, I see as a lower priority relative to all the rest of these. I look forward to the comments from Vasso and Hugo, and the questions and discussion that's to follow. Thank you very much.
Thank you, Steve. I want to directly hand over to Vasso Ioannidou from Bayes Business School, City University of London, where she's doing her research and her teaching, and she's heavily concentrating on banking and corporate finance topics. She's also a member of the Scientific Advisory Committee of the ESRB, so there is room for further discussions among you. But I think you are basically an expert on bank lending behavior, on collateral policies, and in a way, that's what we are speaking about here. And so I would like to hand over to Vasso for your comments. 8 minutes, please.
Thank you, Jan. Thanks for the invitation to discuss this topic. So let me start actually by taking one of the last points that Steve made, and I go to talk first about the lender of second to last resort that Steve mentioned. So what I would like to say, and I'm choosing that to be the first one because I think it's a big issue. And it's an idiosyncrasy of the US, but it's important. And the distortions that the subsidized lending to failing institutions that are provided through FHLB are not to be underestimated. Effectively, they undermine both the lender of last resort function, but also bank supervision and deposit insurance. Now, if the Fed acting in its lender of last resort function sort of provides through the discount window lending to illiquid institutions, but not unsound, and there are all sorts of regulations and constraints about how many days you can lend and so on. If then it's possible to circumvent that through the lending through FHLB, it kind of undermines the institutions we put in place and the function they can place and creates coordination problems. And the same applies for supervision. It applies for deposit insurance, whether you have risk-based deposit insurance premiums or you have limits and so on. It's if you can recycle something which can be risk sensitive, cost of funding into something which isn't, which is effectively what is happening, then it kind of undermines the key institutions we have in place. So I fully agree with Steve's both the guiding principles for the lender of last resort, but also the proposed reforms he puts in place are taking into account the political economy of that. And I think this is really important. It's a first order issue. I'll take some stylized facts for this. So if you look at the data, and this is taken from the work that Steve and co-authors have done for the book I'm discussing, the advances by the FHLB, they dwarf the lending of the Federal Reserve. They're, you can see it's much significantly higher. And when you look at the data in more detail, you're going to see like the banks that have failed, they were behind and they have been borrowing actively quite massive amounts from here. And this was not always the case. If you get from Fred data that go back in time, you're going to see this was not always the case. There was a structural shift that took place in the mid-90s as the thrift institutions came away, and then there was a mobilization from the members. So this has become a lot more significant in recent years. And well, that I don't know if it's not causal, but in the recent years, we had much more instability in the banking sector. So some analysis that kind of tries to kind of distinguish. We had deposit insurance, if you want, for many, many years, and it was working fine, but things have been changing in recent years, and this needs to be thought out more carefully. Now, let me move to topic number 2, the options for reforming deposit insurance. So there are 4 possibilities that already Steve mentioned. So option A, B, C, and D. I'll give you my 2 cents on this, on where I stand. So my view for maintaining limited coverage well below 100%, yes. I think that would be a good idea, and the idea of kind of enforcing that more rigorously with a deposit registry that will allow kind of minimize the gaming through brokerage deposits, it's a good thing. Now, every time you talk about creating new data, there are always, I hear always on the background, oh, but it's costly and so on. But in the era of big data and AI, it doesn't seem that the technological advances we have had on creating databases and maintaining databases doesn't seem like a first order problem. On target, on option B, target increase in coverage for SMEs, my answer there is yes, maybe, but under certain conditions. I will talk about that in a minute. On 100% deposit coverage, I think I will say no with an exclamation mark. And I will add to the mix that Steve is mentioning here about regulators and supervisors, that will increase all the burden on them, put all the blame on them for anything that will could and will go bad sooner or later. and the cost to the public. And I will add to this moral hazard. And I'll come back to that point in a minute, because often there is this comments, okay, you know, depositors, even uninsured depositors, to not discipline. But I think we need to qualify what we mean with discipline in a bit. And then on the answer on option D, on the pawnbroker of all seasons, I will say probably, or maybe best not. I'll explain that. And so that's my 2 cents in broad. So let me talk about option B in a little bit more detail. Option B, I am sympathetic to the idea that you want to have the real economy and SMEs to have a safe space to perform payroll activities and day-to-day operations, right? So I think that is fine. I'm less sympathetic to sort of a possibility of creating a safe space for firms, SMEs, or even large firms to kind of park large cash balances. We know from the data that holdings of cash balances have been going up for a variety of reasons. So so with that disclaimer, I will say yes, creating a space is yes, but that should come with strict conditions, which I'm pretty sure the authors are also pointing out: the registry, eligibility criteria, the size of the deposit insurance funds, the risk sensitivity of deposit insurance. But these are not easy to implement, and we need better data to how to compute the right threshold of what our kind of payroll needs. But if history is any predictor of future, I mean, the risk of gaming and the risk of increased moral hazard, in my view, is pretty real and should not be underestimated. So personally, I remain a bit skeptical on option B. On option D, on the pawnbroker of all seasons, I mean, effectively, the way I look at that is kind of enhancing the responsibilities of the central bank, right? So on its lender of last resort function. I don't think that's a good idea. That's, if anything, what it's going to do is again, likely to exacerbate external pressure, political pressure, or even public pressure on central banks, because things do go wrong. Even if you do the best that you can try and do, things can go wrong, and then it is the institution to which it could undermine its credibility and even threaten its independence. I mean, the threats for external pressures are real.
Vasso, one minute.
Yeah. The threats for pressures are real, both financial independence and personal independence. And here I'm pointing out some work I've been doing in recent years, which show that these are there. And the tension between monetary stability, responsibility, and financial stability are also present. And so if you are going to put the two together, the lines between what is an illiquid institution and what is an insolvent institution, in practice, they often blur. And the timing consistency problem can become bigger. Now, often people say, well, there are Chinese walls between the two mandates. If you look at the data, actually, and here again, I point to a work I have done in the past, but also work done by Pieter, Rosengren, and Tudor in 1999, there are no Chinese mandates. Okay, if you look at the data, there are not. Now, if you don't believe me, I would urge you to look at today's FT article. And Olivier Blanchard had much more experience and many years in this and dealing. It does point out to the real threats that we are facing in an era where global population is increasing. So what is different from March 23? If I wanted to point out, if I look at the data. Well, from Steve's book, what you can see is that a handful of mid-sized banks have effectively wiped out the deposit insurance fund. Now, why is that? Is because there is a high volume of uninsured deposits and a rapid growth that took place before as kind of out of steady state. What I mean with that is, it's not that all of a sudden X bank, SVB, if you want, has a better borrower pool and can lend. So it's getting an influx of huge amounts, and it puts them into long-term deposits. Now, whatever the reason is for the increase, and we can have a separate discussion. I stop. Yeah, one more slide. It is not because SMEs payroll expenses and operational expenses have become bigger. Whether this is because of a policy, an side adverse effect of past policies, or because of structural changes in economy, it doesn't matter at this point moving forward. But it does, but moving forward. But it's more thinking about answering this with deposit insurance. Let's insure everything so we don't have runs is not the answer. So to close, my view here is what we have seen, what we've learned from March 23, and that's very much in line with views of Steve, is that investors can see through accounting, and they do respond to real-time changes in market values, and our regulatory metrics of both capital and liquidity should reflect that better. Now, I want to also emphasize, I understand there is not a lot of appetite for increasing and revising regulatory requirements, but I want to emphasize that removing distortions that may be in place, whether these are various implicit guarantees, or if you want the tax advantage of debt, does have an endogenous adjustment. Institutions will endogenously and privately, in the absence of regulation, increase the amount of capital. A very nice paper by Glenn Shever shows that very nicely for Belgium. Of course, need for regulation remains because private and social optimum is not the same. And what I want to highlight closing is that what we have also learned is that we do need better data on deposits, and the credit registry will be very much needed, not only for proper policy evaluation in calibrating and understanding what is happening exactly, but also for the institution's own risk management purposes. And if I can add, it's even more needed in Europe, where the data are even more scarce than in the US. And I close here.
Yes, so thank you, Vasso. So I have basically just a quick remark, because both of you, Steve and also Vasso, agree that market discipline should come from uninsured large depositors. But at the same time, you show us there are very many of them, even more than ever, and they don't do the thing because they're always bailed out. So
I have an answer to that, and I forgot to cover it, but I have an answer to that.
I just want to mention, this is, for me, this is a bit ironic, right? That you remain
the counterfactual. We have to consider what the counterfactual
is. We can all discuss this.
Yeah. Right. But Hugo is next. Sorry. So before we enter to the discussion, I want to give Hugo a chance to say he observed this discussion. So Hugo has a PhD in economic history, so he loves to look back, and is an adjunct professor of finance at Chicago Booth at the moment. And in between of these two academic pillars, so to speak, he has a broad career in banking, having been with Credit Suisse, actually, global head of financial products some time ago, of course, in the 80s and 90s. And later he moved to Deutsche Bank, where he was the CRO, so basically overseeing risk management. And later with a wealth management firm, Lombard, Odier, in the 2014 to 18. He was also a member of the Likan Commission. That's why we know each other. And I hand over to his comments, his view on what has happened as SVB and what one should do against it. Hugo.
Thank you, Jan. I take a bit different tack than the previous two speakers. And my observations are based on what I lived through in 2008 and 2012. And I noticed that one of the Treasury members is attending the call, Rainer Rauleiter. We had an extremely good Treasury team at Deutsche Bank. And one thing they did together with my help is we classified our depositors. So there was no such thing like an abstract liquidity coverage ratio for the entire bank or an NBFR, what are all these ratios are called. We split our liquidity in all the currencies and had a cockpit where it showed how much short-term liquidity had day by day and how much long-term assets we had and matched them. And we would never have thought to put short-term liquidity into long-term assets. It's structurally, we know that since since Doug Diamond and Dick Big. So these things are the stuff that blow banks up, and they are structurally like this. You don't know when it happens. So in order to manage your currency mismatch, you actually have to avoid it. So prime brokerage money, family office money, institutional investors, corporate deposits or deposits from other banks, which have people who constantly watch it because that's their working capital. We never put into long-term assets. We did not do arbitrage. And we did that by currency. Makes a big, big difference. And that's something where I think so our regulation always talks about the wrong thing. Instead of talking about what can we do to prevent these events to happen, we talk about how to repair them. And it's extremely expensive. I had the pleasure, together with Rainer, who's on this call, to fix Hypo Real Estate, the second bank that went bust after the Lehman's weekend 2 weeks later. The deposit insurance in Germany, which I chaired at that point in time, had assets of 5 billion. The bill for HRE alone was 50 billion. We were fucking bust after one weekend, after one bank. As Vasso said, it's exactly these solutions at the back end are way too expensive. And we need to think about what can we do to prevent them. And what puzzles me all the time, so at Deutsche Bank, we went to extensive training and discussions what to do. When I see people talking about their training, so there's very little training in banking that goes on. So we have a lot of inexperienced people who don't even give it a thought that maturity mismatch could blow up their bank. And I find that amazing. And so when I look, so why do we have traffic rules? To prevent accidents, because it's too expensive to fix all the accidents that happen, so it's better. Why do we have rules for buildings when we build cities and villages? Well, we don't want to have structurally unsafe buildings. Why do we have fire rules? What materials you can use so that they don't burn? Because it's very expensive to fix a road. Why do our heart surgeons have to go through extensive certification before they're allowed to perform heart surgery? Well, because it's our life. We don't want to have inexperienced people. Do we have any certificates for bankers who run maturity mismatch? Zero. So we never talk about this. Our bankers can come to the top without any formal guarantee and exam what they are actually capable of. And I said at that time, I hope it's now better. But in 2012, I said something which I know was true. Had you asked a board member or an executive board member of a big bank in the world, what are the banking rules that apply to you, they would not have known it. This is not acceptable. That's where the whole thing starts. And I think there we need to do much, much, much better. And there are lots of things that we can do. So training is one thing. We could put a very simple statement into our regulations that banks have to prove their maturity mismatch and why it's acceptable that the risks they take. And then they have to classify and show it and demonstrate it rather than pester them with liquidity ratio, which at the end never provide enough liquidity and is anyway different from bank to bank. So regulation has to be, if it's effective, it has to take into account the business models of banks are different. They're not always the same. And I think so once we start to go down this way, then we are going in the right direction. But at this point, we really don't. That this is dangerous. The University of Chicago, the maturity mismatch are dangerous, addressed already in a paper in 2010 that a friend of mine, Christian Leutz, and somebody else wrote when they wrote about maturity transformation. It was all there, so you could have read it, and nevertheless it was done. And that's where we need to be better. We need to link the institutional know-how that society has about these crises, and it goes back, and liquidity crises are by and large always the same. They just have become faster with modern technology. We need to link that institutionally with the way our banks are run. And then we have a shot to avoid that in the future. But more deposit insurance, higher limits, and all that is so incredibly expensive that we will not be able to afford it. And then the whole thing can only be done with with quantitative easing and the inflationary policy, which is not good for us either. So now I want to stop at that. So more than happy to take questions.
Yeah, thank you, Hugo. I thought that some of the points you were raising about better preparation, so to speak, I thought that this is actually what the supervisor is doing. I mean, if they don't look at maturity transformation, so what the hell are they doing?
Can I quickly say? So
Yeah.
the discussion of a stress test is a nice discussion with the executive board for maybe 2 hours. That's what it is. When you think about how do we train the people who run our nuclear power plants, they get to put in a simulator and then they put under stress. I would love to see a bank executive team bidding in a stress in a simulator and then see how they respond for 2 days. That would be interesting. Many of them would fail because they've never done it. But that's the type of thing that we need. And unless we start building, these simulators are not difficult to build. We built one at Deutsche Bank, not we, so my treasury department built one. So it's fascinating what you learn once you start to play around with such instruments. So the data's all there.
Yeah, thank you. Yeah, I think Steve, you wanted to say something already when I
was going to respond, if I might, to a couple of the points that that Vasso and Hugo made. I think that first of all, there's an institutional change that occurred in the federal home loan bank system that explains what happened, which is that the federal home loan bank system, that they broadened the eligibility of who it is that could be members and who it is that could borrow, get advances, and they also reduced the importance of lending for housing. And so some of that is actually insurance companies, but I don't think that explains, that doesn't justify it. It just explains it. I think that this is related to what both of you said. I think it's difficult for authorities to credibly commit to not make depositors whole. I think that's another issue, and so this gets to, I think, very much to your question, Jan, which is that you say, well, we agree that uninsured depositors should monitor banks, but they don't, and not only that, but we agree that the authorities should not bail out the uninsured depositors, yet they do. And so what should we do about this? And I think one answer to this, there's certainly, I'll come to Hugo's answer in a moment, but one answer to this is substantially more subordinated debt, TLAC, MREL, stuff like that. So if you make sure, I mean, I want capital. I want more capital, and I want more capital because I think that the risk-taking of the banks is just something that they cannot resist. Risk-taking when there's limited liability, and all they're doing is sitting there increasing the option value of the put option that they have to give the bankrupt bank back to the government. So I think you do need more capital, but you also need more subordinated debt. And in both of those, if you do that, then you should, under most circumstances, you should be able to reduce the probability of runs under all circumstances, not just the ones where we have Hugo's simulators. By the way, Hugo, I would also put policymakers into simulators. They are forced to do things every day. They're not trained to do anything like what they're doing. You put them into their jobs, and then all of a sudden they're supposed to suddenly be expert in whatever it is that you give them to do. I'm not exactly sure why we think that's a good idea, but we do. We don't think that Formula One drivers go out on the race course and go 300 kilometers an hour without having been in simulators. Similar to the ones that you're describing. Finally, I'll just make one final point, which is that I'm not going to defend Mervyn King's suggestion, except to say that it might actually be the best of all of the bad possibilities that we have available, and we should think about whether or not that's the case. I have exactly the same comments that you had when I first wrote about it several years ago. But anyway, I look forward to the discussion. Thank you.
Yeah, let me just say a few. Well, yeah, Hugo, please.
Can I say something, a pawnbroker idea? I think it's quite a complicated concept, but basically it's right. We need to separate, or we need to break the interconnectivity of our banking crisis. That's what makes them so dangerous. And Jan and I thought about this very hard when we were at the Leibniz Commission in the EU. So one of our proposals was to separate the vital services that banks provide by legal entity from the banks that take the risk. And we said, so the discussion was, so why do derivatives clearing has to happen on the bank's balance sheet? It's not a good idea. So then the clearing mechanism was an outcome. Another one, which was unfortunately not followed up, was why do we allow that the payment system are sitting inside the bank's balance sheet? So you can avoid all that if it's segregated and just requires a legal entity. It's not difficult to do, but neither Jan nor I got the traction for that proposal. People thought we are too weird.
Yeah. And the basic, if I can add just, was the basic hypothesis in the report even was we need to foster exit. Exit is normal in every industry, except for in banks, we fear all sorts of things. So we should make this more easy. But let me add two more things to the discussion we already had then, Vasso. One thing is the policy simulator. I was scared when I heard that we might drive policymakers out of politics, right? So they may not love that altogether. And my real question to Steve is the option you were mentioning in the end, more subordinate capital and less basically ability to run, comes very close to what we had in mind when we published something on this at SAFE, when we said the European model is very different from the American model, because we have always pushed, and Hugo was in the same boat at the time, we pushed for subordinate debt as the instrument for market discipline, rather than hoping that some depositors will understand that it's them who should, and even on your slides, and I think either Vasso or Steve's slide, there was this idea that depositors should basically look more deeply into, I mean, this is not easy to do if you are a company whose turnover and wage payments are building up over the months, and you should really monitor the bank. But Vasso, please.
Yeah, I want to come back to this monitoring thing. So I don't think when we talk about monitoring, you expect the firm, instead of doing their everyday operations, to be checking the books of the bank where that's not the monitoring. But there are plenty of public signals, either by supervisors, rating agencies, a lot of. So all you want to do is that they pay some attention where they move large sums of money or where they go to. You can tell me, well, they went into this one and they didn't pay attention. Well, accidents are going to happen, and there are things. So the counterfactual here is not really. I mean, if we from the past we expect bailouts, of course they don't care, right? So I mean. If you remove the distortion, it's not obvious to me that they need to. It's not that they need to monitor carefully the books of a bank to figure out maybe I should pay attention and not just go with close eyes where I'm going to. Mm-hmm. And because also, suppose that you do insure everything, then you are going to have large vast of money flowing and competition between banks for a bottom to the race. It's not so much the actual, monitoring. Oh, this is a little bit riskier than the other. I go to another bank.
Yeah. In the case of SVB, so these depositors just should have followed the share price. There was large short selling very early on. So some hedge funds had picked up the fact that the accrual amount of the value of the treasuries was not in line with the footnotes where the fair value was indicated. And of course they went short. They said that's not going to last, that will break. And they were right. When you look at the share price, that came down relatively early. So just looking at that gives you an indication. So it could have been done to make Vasso's point.
Yeah, I think, and I'm now looking at the Q&A, and Richard Portes has put in some for thought for all of us. So let me start with what he has to say on to Steve. So because he said, he quotes you, Steve, banks can't have both volatile assets and runnable liabilities and survive. And what he's asking, I thought also when I heard that phrase, what then should banks do if they have no volatile assets? So why should they earn any premium?
So I think that no, but they're still going to earn a premium in expected value. I think that the point here is he actually asks in his question specifically about U.S. Treasuries or about marketable securities, and I think the answer to that is that you need to have mark-to-market accounting on this, and I really think volatility of the asset values is a matter of degree. And as Hugo pointed out, for liabilities, the runnability of the liabilities is also a matter of degree. I mean, I remember this is very consistent, I think, Hugo, with what you said. My discussions with people at Citibank, not Citigroup, but Citibank in 2008 and 2009 was that at the peak of the crisis, they'd lost 4% of their deposits. Now, maybe that wasn't a very good example because people thought that they were going to not be allowed to fail, but it's still the case that most depositors remain very sticky, especially at these bigger banks. But I do think that you can do that as a matter of degree. He's also asking you about the AT1 stuff, Richard, but I think that there in the Credit Suisse case, I would say that they didn't actually use any of the bail-inable, the contingent capital was not used. There was stuff that could have been converted that they chose not to convert. And so I think the AT1 was a very strange, that was a very strange, had a very strange legal status that it was subordinated to equity. I think that stuff should probably not be there, but the stuff that gets converted should.
Yes, exactly. And then there's a question to Hugo. Maybe it's a misunderstanding, but it's about the maturity transformation thing. Are you arguing there shouldn't be maturity transformation, basically, or?
No, not at all. So we just need to take into account what's the behavior of a deposit. So the behavior of a deposit of a retail customer is very different from a big customer. So we all need banks. We all need to keep deposits there. We have to pay bills, blah, blah. There are no alternatives. So these things are very, very sticky, and they can be modeled. So but what Steve said, the degree of modeling is very, very important. You have to be very clear. But when you get big lump sums, so in Deutsche Bank in 2008, so after two days of turmoil when Lehman collapsed, so the doors went open. We got so many requests, and we had to put our interest rate at LIBOR minus 2% to get rid of the money that wanted to come our doors because we had our liquidity management right. So you need to think through what type of deposits you want. Just growing it because you can get them can actually be dangerous. And I remember the call from the Fed in New York at the time, who scolded us and said, "We do not want to take your dollars anymore. So put them into the economy. So don't deposit." And then I had to say, "Well, sorry, so large exposure rules, we can't." So, but these are things which you have to carefully think through. The choice of deposits is a choice. Yeah. And if you suddenly take so many, you should model what you can, and then big ones, the institutional ones and the corporate ones, you shouldn't model. Put them into treasury bills and match these maturities.
So we are already almost done with our time. So I have one final question to Steve and Vasso, and that is the question of the last point that Steve made. Sounded to me like option 5. Option 5 is basically augment the European model, which has very specified bail-inable debt components, so subordinate debt, which is pre-announced as being called when there is a crisis. This is the market discipline arm, I would say, of the funding side of the bank, and the rest is basically protected, right? So that's not the European thing, but I would call this option 5 to use Steve's terminology. And maybe Vasso, could you comment quickly on that? And then Steve, you have the last word to close our session.
Yeah, I mean, I will be I see the benefit of having some part of the debt and sufficient part of the debt which is bail-inable and subject to losing their money. So I will be I see that as a good solution. But I do also agree that at the end of the day is the stockholder discipline is probably the channel that is more likely to give you the most activity. I see the debt part because it's such a big part of the funding of the bank anyhow. You cannot completely mute that, and that's why the bail-inable part allows that you have some part that is playing a role. But yeah, so it's kind of a mix of between having sufficient debt, which is sensitive, and having the rest done by the stockholder discipline.
I would fear stockholder discipline goes in the other direction, right? Because they benefit from this risk.
Well, except that that's right. But if you require banks to have, let's just say, leverage ratios of 10 to 15%, which is what I would do. I don't want you, Hugo, to have a heart attack, but that's what I would do because I believe the social costs of this are basically zero. Then I think that you get lower expected returns because there's lower risk. You get rid of the option value entirely by being so far in the money that the option doesn't have any value left anymore. But I think that realistically, that is what I'm describing right now is completely unrealistic. In a political sense, it's completely unrealistic for the international standard setters. I accept that. And so I think that when we think about what is it that we can realistically do, the answer is we can realistically increase the amount of subordinated debt with various conditions. We can make it bail-inable in various ways if we want, or we can just make it something that exists for the resolution authority to manage. I don't have a lot of, it's going to have a supervisory trigger anyway, so you might as well, which one of those you do doesn't matter much, but you have to keep the banking, the operating subsidiary always open for reasons that are related to what you and Hugo obviously spoke about in your previous work, because otherwise individuals lose access to their lose access to the payment system, and that's very bad. But I think the answer is move more towards a system like the one you described. I would completely support that.
I mean, this would also answer the one question that I haven't mentioned in our Q&A by Florian Heider of what's the purpose of fostering bank runs, right, as an instrument in the policy arena. Okay, I think this is a good conclusion, and I want to thank you very sorry we are running out of time. We could go on, I think, for a while, but I think we will have more chances to discuss in this group. So thank you very much, Vasso, Steve, Hugo, for your time, and the audience for staying on and listening, and I wish you all a good afternoon. Bye-bye.